Hi, I'm Sudeshna Banerjee, Managing Editor, CFO India. As we all know, while the Indian economy is showing resilience and a 7% growth, the mood has shifted from optimism to concern, driven by high inflation and volatility in rupee owing to geopolitical uncertainty. In such an environment, risk management at large is at stake. To understand more on this, we have with us Ganesh Vasudevan, Research Director and Financial Insights at IDC Research. Welcome to the show and thanks for sparing your time to speak with us.
Thank you, Sudeshna.
First up, how could corporates develop a risk culture and appetite?
Yeah, when we talk about the risk culture at large, in fact, the way we look at the risk culture is probably we can split into the three components of people, process, and technology at large. So it begins with the people. At the end of the day, it's all people which brings about that culture. And incidentally, when we talk about the financial industry, or for that matter, the regulated industry at large, so the regulators bring in that discipline in terms of risk culture. The risk culture failed to materialize predominantly in an unregulated ecosystem that we talk about from industry perspective. Besides banks, which are the most regulated entities, you have got the financial institution and the manufacturing and rest of the industry players which comes into play, which has got which brings which don't have a mandate from the regulator's point of view to bring in that risk culture. So the people perspective is something which is the most important besides the external regulatory intervention, which brings about the risk culture broadly into the industry space. So when I said about the three layers which brings in the risk culture is the people, process, and technology. The people, hiring the right kind of people for across the board from top to bottom, bringing in with the sensitivity towards the risk component. Second part is the process, which is the orchestration layer, what we call it, which brings in, we are talking about empowering the employees, educating the employees, training them, and inculcating the risk culture at large. That is the process layer which brings about that. And finally, the technology. Now, the technology definition has undergone change during the recent past. Like initially, it was all about, facilitating a seamless engagement and the operations at large. Now, because of the interconnected ecosystem at large, the risk component has diversified. So that technology layer not only facilitate the measurement and quantification and giving better perspective on the risk, but also helps need to be educated about how that technology has got a what we call related or cascading impact on account of adoption of ecosystem environment. That needs to be brought into the overall learning of the risk aspect. And that is how the risk culture needs to be imbibed across all industry for that matter. Incidentally, in the current context, it is not limited to the bank. Bank, like we have witnessed that bank there is a corresponding collateral impact which can be generated in some other industry, which will be having a bearing impact. Similar to that, the overall ecosystem needs to have a synergized approach towards risk culture to bring about that sanity in the overall market.
When you're talking about all this, some time ago, it just reminded me that some time ago you had said corporate banking is poised to gain momentum in India in the immediate future.
Yeah. It's interesting to note that, if we see the corporate banking trend in India at large, during the last decade, it has been quite subdued, and rather not subdued, it has been quite on a negative path. And the focus has been predominantly on the retail banking space. Now, with corporate banking, most possibly, the pandemic has been a blessing in disguise to a certain extent because it disrupted the entire ecosystem at large. And of late, if we see the focus of the financial institution, the recently released annual reports of the banks and all those things, you will see that, there is a distinct shift towards the wholesale or the corporate banking space. And when we say corporate banking, that piece has got a different connotation with financial institutions. So predominantly the commercial banking space, some corporate banking is mostly considered aligned to the larger enterprises. But there is a commercial banking category, which is commercial banking space, catering to the MSME segment and rest of the industry segments. So it is important there, that is the space where the banks see significant value. And the primary reason for that is that, like initially, the first query which you asked about the risk component, banks are engaging with the MSMEs and providing them the platform to really enrich their risk ecosystem and support in their entire supply chain network. And that is how the engagement of the corporate banking space is widening in terms of products and services, but also it is becoming an integral part of the industry, and that's how the transition is gradually shifting. And going forward, we will see that with the intervention of the government, whether it be providing the infrastructural ecosystem with the threads and other aggregating platform besides the India stack, all these are facilitating an adoption or wider adoption of corporate banking or expansion of the corporate banking. Yeah.
Let's touch upon MSMEs. We all know the sector is vulnerable to risks arising from cyber attacks, liquidity crunch, lack of succession planning, and poor reputation management. Now, we know while SEBI mandates the appointment of risk management committees for the top 1,000 listed companies, there are no guidelines for small businesses, which are the largest employment generators of the country. So, what's the way forward?
Yeah, it's an interesting perspective. Like if you see the way SEBI has gone about bringing about or introducing the risk component, like initially it was 500 listed entities in terms of market capitalization, then extending it to 1,000. So we are talking about the listed entities of 8,000 or 9,000 odd. I'm not the actual figure, but in somewhere in that range. So you can see that a significant chunk of enterprises are left in terms of the mandatory regulatory nudge for risk culture. And as you said in your query itself, okay, those are the primary areas of concern, whether it be cyber attack because of the increasing connectivity or participation in the ecosystem economy or digital economy, and you have got the liquidity concern, which like peaked at the time initially during the pandemic, and thereafter it has subdued significantly because of the policy intervention and rest of the things, and the succession planning and transparency. So like what we said in the initial introduction, where we focused upon risk culture per se, that's something which has to be extended, which needs to be extended beyond the 1,000 listed entities. While that is a good intervention in terms of SEBI bringing about that mandate for the 1,000 listed entity, but consciously for the entities per se, independent of the regulatory nudge, it is important for them to leverage that transparency or bring about the transparency and adoption of the risk culture. And because in the long term, if you see, whether it be liquidity crunch is primarily an outcome of the leverage. If at all you have got a risk culture and transparency in the operations, probably you may not be having that liberty. If at all you are professionally managed entity, you may not have the liberty, or individuals will not be taking that unknown risk to bring about at times it blows out on beyond your control. So that controls will be established if at all that component in terms of the risk culture is established. So the entities which are not factored as a part of SEBI guidelines, whether it be 1,000, beyond that, the rest of the entities should refer to that guidelines in terms of establishing the ER management vertical within the enterprise and bringing about the transparency and the control which is required. So that going forward, as they expand their business, possibly not only in terms of their borrowings, it helps, but also in terms of any other operational liberty which they need to, if at all, once they establish the enterprise risk culture.
Thank you. We now go to a larger economic situation when it comes to risk. Now, the present problem plaguing India is rupee volatility, if you know. To control volatility, we know that Reserve Bank of India already responded to Fed's rate hike by raising the repo rate by 40 bips on 4th of May. Earlier also, if we have seen that the central bank has announced $10 billion worth of rupee-dollar swaps. First in March and then in April, taking out liquidity worth 75,000 crore rupees from the system. Yet, the situation is grim. We are fighting. and pushing up costs of manufacturing and imports. Like, what's the way forward now?
It's a catch-22 position, I would say. In fact, it's quite a phase to be in. Because if you see that, okay, you mentioned about the currency swap during the March, during early this year, I feel that, okay, probably the regulators in Indian case, so the Reserve Bank of India, woke up last week, and I had abruptly just before the IPO disrupted the market by increasing the repo rate by 40 basis point. So that they were avoiding that rates through policy rates in terms of repo or reverse repo and CRR increase until early this month. It's primarily because they wanted to balance the inflation and the growth objectives. Now that inflation is really blowing out of proportion, and that is not a national phenomenon. If you see globally, just because of the conflict in the Europe, it's the commodity prices really went out of control, and besides that, there is an inflationary trends in general in the market, whether it be whether in US. Almost 3 decades or 4 decades high the inflation trends is. So it is a global phenomena, and it is important for a country like emerging countries like India to take a balanced view about, and that is the way the regulators are going about, whether it be currency swap or variable reverse repo rates, products and all those things. It is basically without changing the underlying interest rate component. They wanted to bring about the liquidity controls, because as soon as we heard about the repo rate increased, or for that matter the CRR was increased last week, the first thing was that my home loan rates or my any other lending rates are going to shoot up. At the same time, there is a comfort in terms of corresponding increase in the deposit products as well. But still, it will incidentally, to a certain extent, liquidity has not been a concern per se. It was so skewed in the Indian context. On one hand, the larger corporates were flush with fund, had revenues to invest and all those things, but they didn't have any appropriate channels to invest. But the MSME, on the other hand, they're facing the liquidity crunch. So the policy decision, in fact, incidentally applies uniformly, which brings about further disparity. So that is what the regulators needs to think through about when they are dabbling with the policy rates, so that it don't have a ramification beyond the inflation. They want to control the inflation, at the same time the growths are not scuttled while controlling the inflation. So that phase, possibly as we speak, in fact the next 6 months will be a trying time, and there is not much leeway for the regulators as well to really clamp down upon. It depends upon how the demand supplies really evolve. Because in India, unlike the inflation is normally attributed to the increasing demands. If at all it is caused by the supply crunch, then possibly for the regulators or the policy makers it becomes a challenge. And in India, it was more to do with the latter. So that's why it is important that next 2-3 months, how the regulators are going to take measures to balance the inflation versus growth is something which we need to take note of. Nobody can foresee that, honestly. In fact, nobody anticipated the kind of correction or the rate revision which happened last week. Nobody anticipated. That's why the market crashed all of a sudden as soon as the news came out. So similarly, going forward also, but it is going to tighten. That is the one anticipation. So it is more like a white swan which the industry needs to be prepared for.
Coming back to markets again, if you see, the markets have seen the big ticket LIC IPO recently. Now, however, if we look into the valuation of the insurance giant, it was double of what it is today. You can blame it on various other factors, but is it market headwinds or something else that is affecting it?
Look, my personal gut feeling is the market headwinds. The reality has really seeped in. And primarily, you can attribute it to the listing of the fintechs during the recent past, whether it be. So you see any of the fintechs which has listed in Indian context, or for that matter globally. we are only having more, we talk more about the Indian listing, but if you see the phenomena is global. That US almost from the peak of what the fintechs were 3 to 6 months back, they are down by more than 60, 70 odd percent. So that's a massive depreciation of the valuation for the fintechs. So that is something which has been factored in and good for the retail customer predominantly. If you ask me, okay, the LIC valuation, which was initially double of what it was a couple of months back and brought it down, it is more realistic. Possibly it will safeguard the interest of the retail investors like you and me. Because if at all the people who invested in Indian context, Paytm or even Nykaa for that matter, which had a bumper opening, but as we speak, in fact, all of them are bleeding effectively in terms of return on their investment. Their funds are blocked. So at least that, to avoid that consequences for a premier entity like LIC, probably it made sense. I feel that, okay, it's a wise call in terms of, okay, recalibrating the valuation, so that still I would say that, okay, whether it is recalibrated appropriately to the right extent, or is it something still, so we will get to know once today's listing happens and allotment and what is the final pricing which comes, we get to know. Then we can say, okay, to what extent the pricing is. If at all the retail investor end up having the premium or on their investment, then it's what, okay, we can appreciate the valuation in hindsight. But as we speak, okay, probably it might be a bit premature on that front.
Thank you. As for coming a little bit from the markets to climate change, as per research data, we have seen that climate change transitions is creating massive capital redeployment. Capital spending on physical assets for energy and land use systems in a net zero transition between 2021 to 2050 will amount to about $275 trillion or $9.2 trillion per year on an average. How do governance in the ESG get affected?
Yeah, that's absolutely an interesting area which is being talked about. Honestly, as we speak, it is absolutely grey and abstract. Even the end users don't have a visibility in terms of how to really empirically assess the ESG components. So that's why you might have seen, read about that, okay, SEBI coming out with, okay, the ESG rating providers, the transparency in their operations. So that is something which is coming into a focus significantly. And especially in terms of banking, I would say that, okay, whether the lending decisions are significantly influenced by the ESG practices of the end beneficiaries. At the same time, the borrowings of the banks is getting impacted by the practices of the bank in terms of their lending and in terms of, okay, how they are exercising caution in terms of ESG requirements. So that is something the banks are looking at, a financial institution in particular, because they are at the intersection of the entire ecosystem, isn't it? They are facilitating with the funding and the advances which is required for the business. And at the same time, they need to recalibrate, okay, what are the consequences of those lending or their financial decision on the industry at large, contributing to the ESG. So on that front, I would say all the nations, for that matter, India in particular, with the recent guidelines, almost all the financial institution has taken cognizance of it. Like Axis Bank has already established a board level committee for the ESG. Similar to that, all the annual report, if you see that, okay, annual report has a reference for their ESG initiatives for most of the bigger, larger financial institutions. And they are bringing about discipline in terms of the lending, which has a clear bearing. And lending is, they are anchoring the lending entire policies with ESG requirements. And that is where the focus is for the banks, because that lending at the portfolio, at the same time, they need to balance with the borrowings on account of the ESG. And that space is something which is evolving right now as we speak, not something which is matured enough to really bring about a standardization in the industry. Hopefully, sooner than later, we can see that, okay, ESG adoption brings about significant changes in the way we are financial institution operate and the industry at large operates. Specifically in the case of financial institution, climate is not limited. They factor in the ESG, environment, social, and the governance aspect. It is bring about the synergy between these three verticals, especially social and governance overall, like whereby it has a bearing not only in terms of their lending portfolio, but also in terms of the compliance and regulation. That social component is having a direct bearing on the way the financial institution define their anti-money laundering policies. So those kind of related dependency is something which we need to, which is still evolving and figuring it out. Like IDC anticipates that significant amount of their AML initiative going forward will be having the social component factored in. And so that, okay, you are not in conflict with the regulators when it comes to the compliance.
Last but not the least, and although this is much limited in India, we have often seen over-the-counter transactions by fund managers have a cascading effect on the economy. Take, for example, the recent case of Archegos Capital Management, which hid the fund's extreme exposure from its lenders and put banks and financial institutions world over in a sticky position. It also raises questions of risk management policies at large, especially when you're going to global shores, when you have exposure in global markets. Therefore, your comments on that.
Yeah, it's an interesting observation with regard to whatever happened in the Archegos case. If closer home, the closest incidentally we witnessed during the last week is, I would say, that excess mutual fund issue. It was more something, okay, whereby, okay, over the counter, though not in exactly the same manner. But interesting part of that whole thing is that it was like it is bilateral in one sense. At the same time, there was a certain component of work from home which contributed to that collapse. So those are the things which we need to take into cognizance. Like in this specific case, it was the over-the-counter deals which remained siloed and very narrow to the bilateral party, not beyond them. And that's why the other parties were exposing themselves without knowing the risk or underlying risk the counterparty is exposed to. So on that front, it is important to have standardized the over-the-counter transactions and having a better guidelines for disclosure norms. So that, okay, when a disclosure needs to be on real-time basis, ideally, and it becomes handy that, okay, not only brings efficiency in the system, but also significantly mitigates the counterparty risk exposure, which otherwise remains hidden in the case of what happened in the case which you mentioned.
Yeah, Archegos, yes.
Archegos case, whereby, okay, it remained limited to the bilateral parties within the parties over-the-counter deals which they signed up with, and it remained siloed till it blew out of proportion. It's the same way. So what happened from the regulator's perspective, it is paramount. Learning from that is that, okay, the disclosure on a real-time basis, if at all some hedge fund which is engaging, or for that matter, any over-the-counter transactions, as soon as the transactions are concluded, probably there should be a mechanism which brings about, okay, disclosure for a wider industry or the investor's perspective, so that, okay, these kind of exceptions can be avoided. And specifically with the changing working model, like if at all I have to, since I brought in the XSMF perspective, like
yes,
there are certain components within the operating model, like till now, Axis case, if I have to highlight specifically, the fund manager or the dealer's role, it was more like a captive role in the office without any access to communication, and you are dealing with it, and so the sanctity of the entire transaction was maintained. But with the work from home, you have lost a lot many control on your people, and it depends upon, like we started off with the risk culture, how sensitive you are as an employee about the entire thing, and bring in that own self-discipline. has gained significance, and had it been practiced, possibly that event could have been avoided in the excess mutual funds. So those are the areas where they need to focus upon as an organization as they revamp their work from home and distributed working culture and all those things, how they can bring about that control in terms of confidentiality and the integrity of the resources.
Thank you. With that, we come to an end of this session. It was wonderful to have you join us. Thank you so much.
Thanks a lot. It was my pleasure to meet you. Thanks a lot.